Now, remember the building blocks. Quickly, I just want to take about 10 minutes on this part and then we'll go to the questions. You'll remember that for you to construct a statement of financial position, you need to have assets, and you also need to have liabilities, and you also need to have equity. Those of you who are into accounting at basic level, you'll appreciate this can be put into an equation which we refer to as the accounting equation. What does it say? It says assets are equal to equity plus liabilities. If you add liabilities and equity, it gives you the assets of the business. I think we have explained this at some point. And these so-called assets are divided into two groups. And when we divide these two groups, it's not just but recall. I want you to remember that these two divisions will appear in the statement of financial position as classes of assets. You've got your non-current asset and then your current assets. So tonight we shall see where do we put these non-current assets and where do you put these current assets when we are constructing the statement of financial position. And secondly, you will also appreciate that your liabilities are also categorized into two. You've got your non-current and your current liabilities. Now, talking of non-current assets, it's very, very important that we get to know because we'll need to pull these out of a trial balance or a list and we construct the statement of financial position. And you can't do so if you don't know what constitutes non-current assets. And these are what your non-current assets will be. You'll have the likes of property, plant, and equipment, your PPE, and these include your vehicles and so forth. And they are always, for your KCQs, remember, they are always recorded at historical cost. When we get to that point, we also need to understand this very important concept. They can give you on your formative assessment, which will be opening before long, that when you're calculating carrying value is going to be cost minus accumulated depreciation. And at some point, you need to ask yourself, how do I arrive at accumulated depreciation? And we shall leave that to subsequent sessions. And there are two methods of calculating depreciation, as you have seen, and we will apply them as we proceed. And now, under your non-current assets, you're not only going to have tangible assets, you'll also have your financial assets, such as your fixed deposit. And please pay special attention. Tonight, we shall see how crucial it is to understand the nature of fixed deposit, because depending on this time frame, it can be either a non-current asset or a current asset. So please separate the amount maturing within the next 12 months. And the question under the adjustments will tell you that a portion of the fixed deposit will be maturing. And please, ladies and gentlemen, make sure when you get to that point, that's where your examiner will want to trick you. And the portion maturing is shown under the current assets, under cash and cash equivalent. So tonight we shall see how that happens. Now, after having done the current assets, non-current assets, you see there are two. You've got your tangible group and then you've got your financial. And then when you're done there, you go to the next group of assets, which is your current asset. And these include your inventory, you've got your trade and other receivables, and you've got your cash and cash equivalents. Ladies and gentlemen, if you check there, that order that would they appear there is not accidentally. It's actually as a result of a principle. We record them in this order, starting off with inventory, followed by trade and other receivables, and eventually we write your cash and cash equivalents. We say in accounting speak, we record them in their inverse of liquidity, which implies we record the less liquid. Liquid meaning its ability to be converted into cash. Is it cash or can you convert it to cash easily? That's called liquidity. So if you look at inventory, it's less liquid because you need to sell it first before you can realize cash. Trade and other receivables, people will owe you, so you can call them to pay. But the ultra liquid one is your cash and cash equivalents. Now, having identified the three current assets are subdivided into three groups. We have got inventory, we have got trade and other receivables, we have got cash and cash equivalents. Your job in the question that we're going to be doing under this part is to identify what goes under inventory and what goes under trade and other receivables and what constitutes your cash and cash equivalents. And once you have listed them, you add them, they give you a total of current assets. Now, your inventories from the question you are going to be answering will constitute the following: trading inventory. Where do you get this one? It comes from adjustment number one all the time. When they say physical count, that figure there is what you're going to reflect as part of trading inventory. Same applies to your stationery or consumables or so forth, right? They can write consumables, they can write stationery, depending on what the question brings, or it can be packing material, but there will always be two: trading inventory with stationery or these other three. All right, so they will pick one of those to go together with trading inventory. And then use amount from physical account on the adjustment section. Please, that is an exam missile. We are telling you that in the questions you're going to answer, they will give you two figures for trading inventory. There will be a figure in the trial balance, and there will be the other one under adjustments. And now when you get into the examination, you can get confused. Which of those two figures do I pick? It is a thumb rule that you pick the one at the bottom. Why? Because it has been verified through physical count. All right? I'm moving a bit fast because I want us to recap. We did this. I want to link this up with the calculation that we're going to make now. Then the next one is going to be your trade and other receivables. Remember, these are current answers, and this will constitute your trade debtors. And please, from the trade debtors, ensure that you subtract provision for bad debts. And where will this come from? It will be provided under the adjustment, maybe 5% of debtors. So you subtract that so that you arrive at net debtors. The likes of prepaid expenses, your accrued income. So all those will be put there. And the next one is your cash and cash equivalents. And you saw at the top, when the fixed deposit matures, we say we subtract. So if we subtract it at the top there, we must add it somewhere. So from the top there, it will fall under cash and cash equivalents. That's why you have fixed deposit maturing within the next 12 months. And besides any other item there in this statement, your examiner will look at this with hawkish eyes because quite a number of students don't do well across universities. And then the next thing, which will be very easy to identify as part of cash and cash equivalent, is your cash at bank. So the value for bank. And at times they may say a bank statement indicates that something was handled by the bank on behalf of the client. So that thing is not included in that balance. You may have bank charges, so you'll have to subtract them, or you may have to add interest income, which was not reflected in your records, which came in the form of a bank statement. Remember the little part you did at high school, which you referred to as bank reconciliation. All right. And then we have got your cash float. Cash float is another one. And then we've got your paid cash. And maybe you may have savings, but on very rare occasions. And your liabilities, ladies and gentlemen, are also divided into two groups. And these are your current and your non-current. Talking of current, you'll have, as we talked about this before, you'll have examples such as creditors, which are trade payables, your current portion of loan, and then your bank overdraft, if there's any, and then accrued expenses, and then income received in advance. Please know these so that when we do the statement of financial position, you know why we classify it there. And then trade and other payables will be your creditors control, deferred income, accrued expenses, bank overdraft, short term. I think is a repetition of what we already done there. Non-current liabilities is usually your mortgage loan. Subtract the portion maturing within the next 12 months. I think I've already handled that with fixed deposit. And when we get unit number 4, we shall introduce you to what are called the debentures. Right. The next session is your equity. Right. This will always be calculated as you will see tonight, capital plus net profit minus drawings. That gives you a equity. All right. And this here is a bit of example that relates to your statement of financial position. I want you to have this abridged presentation after this session. Go through it. It will help you. It's kind of like a manual which unlocks the functions of your statement of financial position. All right. I'm not going to go over that thing because we did mention this in some